All right, so today we're strapping in and getting ready for a deep dive into the wild world of Jim Cramer.
That's right, the Mad Money Maestro himself.
But, and here's the twist, we're not dissecting his on-screen antics.
Oh no, we're going deeper.
Much deeper. We're cracking open his book, 25 Rules for Investing, to see what nuggets of wisdom we can unearth.
And what's fascinating is how Cramer manages to bridge this gap between Wall Street and, Main Street.
Yeah.
These rules aren't just for the hedge fund elite, they're for anyone, really, who wants to understand the fundamentals of building wealth. Right.
Absolutely. And, let's be honest, we've all felt that tug of greed, that I need to squeeze out every last penny feeling.
Oh, yeah.
And that brings us to Cramer's first rule, which is holes make money, bears make money, pigs get slaughtered.
Okay.
And he's not just talking about market trends here. This is deeper. This is about, the dangers of letting your emotions, your gut, drive your decisions.
Yeah, it's like that classic saying, fear and greed, those are the two emotions that really drive the markets, right?
Yeah.
You see a stock skyrocketing, you're like, I gotta get in on that. Or it starts to dip and panic sets in, you sell, sell, sell.
Yeah.
Cramer's been there. He's got the battle scars to prove it.
He does. He totally does. And he even tells this great story about how he coined the term FANG, Facebook, Amazon, Netflix, and Google.
Right.
But then, get this, he sold off his Amazon stock way too early because he was afraid of getting greedy. Can you imagine?
Oh, wow.
The fear of missing out on even more profit, right?
Yeah.
Well, guess what? The stock went up another 50% after he bailed.
Oof, that's gotta hurt.
Talk about a lesson learned the hard way. But that's what makes these rules so relatable. Even a Wall Street veteran like Cramer, he's human. He makes mistakes.
He does.
He falls prey to those very human emotions. So think about it. Have you ever held on to something for way too long, hoping for a better outcome?
Oh, yeah.
A stock, a car, a relationship.
Oh, I've been there.
Did it pay off? Or did you just end up feeling, well, a bit like a pig?
Yeah, we've all been there. And, speaking of letting emotions get the better of us, Cramer's rule number 2 hits another nerve. It's okay to pay the taxes.
Oh, man.
I mean, who actually enjoys handing over their hard-earned cash to the tax man?
No one.
Right, no one. But here's the thing. Sometimes that fear of taxes, it can make us do some pretty irrational things. You cling to an investment even when, logically, it's time to sell, all because you're so focused on dodging that capital gains hit.
He uses this really interesting anecdote about a hedge fund manager who was recommending Macy's stock
Okay.
based purely on their real estate holdings, right?
Interesting.
Now, the stock had already gone on a tear, but some people just wouldn't sell.
Really?
Taxes, purely because of the taxes.
Wow.
And you know what? The stock tanked. They ended up with a much smaller pie, taxes or not.
Ouch.
Ouch is right. It's like, the classic case of letting the tail bag the dog.
Yeah.
What's the lesson here? Sometimes it's better to take the profits, pay your dues, right, than to risk losing it all trying to outsmart the IRS. Let's shift gears a bit. Let's talk strategy. Cramer's rule number 3 is don't buy all at once.
Okay.
And this one, I'll be honest, this one really challenged my go big or go home mentality.
Oh, yeah.
He's a huge advocate of staging your buys, spreading your investments out over time.
Interesting. So kind of like, would you put all your eggs in one basket and then walk across a tightrope?
Exactly.
Probably not the best strategy, right?
No.
Same with investing. By spreading out your purchases, you're essentially averaging out your entry point.
Right.
You're reducing your exposure to those sudden market swings.
It's all about risk management. And Cramer, he walks the walk, too. He talks about how he used to buy stocks in 5,000 share chunks.
Wow.
This was back in his hedge fund days. And even now, when he's picking for his Action Alerts Plus portfolio, he's buying in 500 share increments throughout the day.
Interesting.
He's not trying to time the market. He's got a strategy
Right.
that mitigates risk.
And, you don't have to be a Wall Street titan to apply this.
No.
Even if you're investing, a couple $100 a month,
Yeah,
you can still benefit from this idea of staging those buys.
right.
Instead of just dumping it all in at once, break it up.
Smaller purchases.
Smaller purchases, yeah, you'd be surprised at how this simple shift can really smooth out those returns over time.
I think it's brilliant. All right, we've talked about greed. We've tackled taxes. Let's get to the heart of it now, finding good companies.
Okay, yeah.
Rule number 4. Buy damaged stocks, not damaged companies.
All right, this is good.
This is where research becomes your best friend.
Oh, for sure.
It's not about just blindly grabbing bargains. It's understanding the difference between a temporary setback
Yeah.
and a fundamental flaw.
It's like going to the grocery store, right?
Yes.
You find a perfectly good piece of fruit that's just a little bruised.
Okay.
That's a discount worth snagging.
It
But then
is.
there's the fruit that's just gone bad, moldy, mushy.
You wouldn't buy that.
You're not buying that.
No.
Same with stocks.
Right.
A company facing a temporary headwind, that could be a buying
It
opportunity.
could be.
But a company with those deep systemic issues,
Stay away.
that's a recipe for disaster.
Disaster. And Cramer, he illustrates this with the example of Sendent.
Okay.
Now, this was a company that was basically built on accounting fraud.
Oh, wow.
Went from $36 a share to $12 a share.
Oh, man.
And people who thought they were getting a steal,
Yeah.
they ended up getting burned.
Yeah.
That's a damaged company, not a damaged stock.
Right. So how do you avoid falling into that trap?
Research.
Research, yeah. Before you jump on any so-called bargain, ask yourself, why is this stock down?
Right.
Is it a market-wide dip? Is it, a short-term hiccup? Or is it something more sinister?
Something deeper. Speaking of avoiding traps, let's talk about one of the most fundamental principles of investing, diversification.
Oh, yeah.
Cramer's rule number 5 is diversify to control risk. This isn't just about spreading your money around. It's about building a portfolio that can weather any storm.
It's like building a house.
Okay.
You wouldn't build it on just one pillar, right?
Right.
You want a solid foundation, multiple supports to withstand whatever elements get thrown your way.
Right.
Diversification is your investment foundation.
Yes.
It's about making sure that if one sector, if one industry takes a hit, your entire portfolio doesn't crumble.
And this is where Cramer's concept of what he called faux diversification comes in.
Faux diversification, I like that.
He argues that just owning a bunch of stocks doesn't actually mean you're diversified.
Yeah.
Think about the FAing stocks.
Okay.
They're all big names, right?
Right.
But they're all tech companies, all vulnerable to those same trends and risks.
Yeah, true.
Owning all of them isn't diversification. It's just putting all your eggs in slightly different looking baskets.
Okay, so here's a question for you and for everyone listening. Take a look at your own portfolio. Do you really know how diversified it is?
Yeah.
Are you overly concentrated in any one sector or industry?
It's easy to fall into that trap without even realizing it. All right, we got diversification down. Let's talk about staying ahead of the curve. Cramer's rule number 6. Do your stock homework.
Okay, I like this.
This is where he really challenges that buy and hold dogma.
Oh, yeah.
He's not saying you need to be glued to your trading app, 2047.
Right, right.
But you can't just set it and forget it either.
The business world is constantly evolving.
Oh, yeah.
And those companies you're invested in, they're no different.
Right.
New competitors pop up, technologies disrupt industries, consumer tastes change.
Always changing.
Always changing.
Right.
All of these factors can really impact a company's performance.
Absolutely.
And if you're not paying attention, you could miss those vital signs, those crucial signs of change.
But, the good news is we have more access to information than ever before.
Oh, yeah.
Company websites, earnings calls, analyst reports, it's all there.
It is.
Often just a click away. You don't need to be some Wall Street insider to stay informed.
Exactly. And, if you're feeling overwhelmed by, the sheer volume of information out there.
Oh, it could be overwhelming.
It's a lot. There are options.
There are.
Index funds, they offer that broad market exposure.
Yeah.
Or you could seek guidance from a financial professional,
I agree.
The point is, ignorance is not bliss.
Not when it comes to investing.
No, no, no.
So we've talked about research, we've talked about diversification, staying informed. Let's address the big one, fear.
Okay.
Cramer's rule number 7. No one made a dime by panicking.
That's a good one.
And we've all felt it, that urge to hit that sell button when the market takes a nosedive.
Oh, yeah.
But acting on that fear rarely leads to good outcomes.
No, it really doesn't. You see those headlines screaming about a market crash. You hear everyone freaking out, friends, family, and suddenly you're convinced the world is ending.
Oh, yeah.
But here's the thing. The market's a roller coaster.
It is.
And downturns are a natural part of the ride.
Absolutely.
It's about having that discipline to ride out those dips and not make decisions based on fear.
And Cramer's got some great stories about this. Being on air during the 2010 flash crash.
Oh, wow.
The Dow dropped almost 1,000 points in nights.
Talk about panic-inducing.
Talk about panic-inducing. But instead of freaking out, he urged viewers to use limit orders to buy stocks that they loved. And many people actually made money doing that, going against that herd mentality.
That's incredible.
It's a great illustration of how having a plan, even a simple plan,
Right.
can help you stay grounded when the market gets crazy.
You know what it's like? It's like having a fire escape plan, right?
Yes.
You hope you'll never need it.
Never need it.
But if that alarm goes off, you know exactly what to do.
You're prepared. So we've talked about, controlling our emotions, doing our research, diversifying our portfolios.
Okay.
Let's get to the fun part, finding great companies.
I like this part.
Cramer's rule number 8, buy best-of-breed companies.
All right, let's hear it.
This is where his analogy of buying a car really resonates.
Okay.
So think about it. When you're in the market for a new ride, Do you just automatically go for the cheapest option?
No.
Or do you factor in things like reliability,
Absolutely. Performance, the brand reputation.
brand reputation?
Yeah.
It's the same with stocks.
It's true. It's so true.
It's so easy to be seduced by a bargain stock, especially when the price has been hammered down.
Oh, yeah, but often those bargains, they can turn out to be value traps.
They can.
You're essentially buying a lemon.
A lemon.
Instead, focus on companies with a strong track record,
Right.
consistent earnings growth, solid management team.
Solid management.
Yeah, those are the companies that are built to last.
Built to last.
Even when the market throws a curveball.
He emphasizes they might not always be the cheapest,
Right.
but they offer that long-term value and a greater chance of outperforming the market over time.
It's like buying a well-made pair of shoes.
Oh, okay.
Sure, you could grab those cheap knockoffs, but they'll fall apart in a couple months, right?
Right.
Investing in quality, it often means investing in peace of mind.
I like that. Okay, so we're looking for best-in-breed companies, but what happens when the market takes a tumble and that portfolio starts to, bleed red?
Yeah, what do you do?
Kramer's rule number 9 is defend some stocks, not all.
Okay.
This is about recognizing, you can't save everything in a downturn.
Right.
It's about making those tough choices.
Yeah.
Prioritizing your strongest holdings. He uses this great analogy of a battlefield plan.
Oh, I like this.
He says, he who defends everything defends nothing.
Ooh, that's good.
It's about choosing your battles, allocating your resources strategically.
Yeah, that's smart.
And in a market downturn, what does that mean?
Right.
Deciding which stocks you're going to double down on, which ones you're going to let go.
It's like pruning a garden, you know?
Yes.
You can't let all the plants just grow unchecked.
No, no, no.
Sometimes you got to trim back those weaker ones to allow the stronger ones to flourish.
Okay, so we're defending our strongest holdings. But what about those tempting rumors of potential takeovers?
Oh, yeah, those are always swirling around.
Kramer's rule number 10, bad buys won't become takeovers. He's basically saying don't chase acquisitions, especially with companies that are already struggling.
Okay, that makes sense. I mean, would you buy a beat-up car hoping someone's going to offer you double the price for it?
No,
Probably not.
probably not.
It's the same with stocks, right? Companies with weak fundamentals, they're rarely attractive takeover targets.
No, they're not. It's the companies that are already doing well
Yeah, the strong ones.
that become even more desirable.
So don't speculate based on rumors or hype about potential takeovers.
No.
Focus on companies with those solid fundamentals, strong track record, a bright future.
Exactly. Those are the ones most likely to attract the attention of a potential acquirer. So we're being selective, focusing on quality, ignoring the hype. Let's talk about something that might seem counterintuitive, simplicity.
Okay.
Kramer's rule number 11, don't own too many stocks.
Oh, interesting.
And this comes from his experience as a hedge fund manager.
Right, he was in the trenches.
He was in the trenches.
Yeah.
And what he found was when he had fewer positions,
Okay.
he actually performed better.
Mm.
It allowed him to really focus his attention, truly understand the companies that he was invested in.
It's about depth over breadth.
Depth over breadth. He shares this great anecdote about his position sheets. He says, when I lost the most money, my position sheets were as thick as a brick.
Wow.
But when he made the most, it was just one sheet of paper.
That's amazing.
It's a powerful illustration of how focusing on a smaller number of what he calls high-conviction investments can lead to those better outcomes.
Quality over quantity. Think about it. Can you really stay on top of like all the news, earnings reports, industry trends for dozens of companies?
No.
Or would you be better off being super selective, deeply understanding, just a handful?
And that brings us to one of Kramer's, I think, most counterintuitive rules.
Okay.
Cash is for winners.
Wow.
Now, this might seem like heresy in this always be invested world of finance.
Right.
But Kramer argues holding cash can actually be a strategic move.
So it's about recognizing that sometimes the best investment is no investment at all.
Right.
Especially when you're a little uncertain about market direction.
Yeah.
Or you see those potential risks on the horizon.
Yeah.
Holding cash, it doesn't mean you're giving up. It just means you're preserving your capital
Preserving capital, being smart.
for better opportunities down the road.
He even admits that when he tried shorting and hedging, he often lost money.
Really?
He realized trying to outsmart the market with these complex strategies often backfired.
So it's about staying disciplined
Disciplined
and not feeling like you have to be in the market all the time.
all the time now.
Right. When you see everyone else piling into the latest hot stock, it's tempting to jump on that bandwagon.
Oh, it is. It is.
But sometimes the smartest move is to sit on the sidelines.
And wait for the dust to settle.
Wait for the dust to settle. That's right. All right, so we're holding cash strategically. We're not letting fear make our decisions for us. But what about that nagging feeling of regret? You know, when we miss out on a big winner.
Oh, the what if.
Yeah, the what if.
The shoulda, coulda, wouldas.
Oh, I know that feeling.
Kramer's rule number 13 addresses this head on. No woulda, shoulda, couldas.
Okay, I like this.
It's about recognizing that Dwelling on those past mistakes, it's just counterproductive.
Oh, it is. It is. It's like driving a car while you're constantly looking in the rearview mirror.
Right.
You might avoid a fender bender, but you're going to miss what's ahead of you.
You are.
Investing, it's about looking forward, not backward.
Forward. And Cramer admits he used to obsess over trades that he missed.
Yeah,
But he realized it was a mental trap.
it is. It is.
He actively fights that now.
Good for him.
It's about focusing your energy on the present and the future.
Absolutely. Don't let those past mistakes paralyze you.
No.
Learn from them, move on.
Eyes on the road ahead.
Keep your eyes on the road. So we're learning from mistakes, but what about those market corrections?
They're inevitable.
The ones that seem to come out of nowhere.
Cramer's Rule 14, expect, don't fear, corrections.
Okay.
He argues corrections are a natural part of the market cycle,
They are.
like rain in the spring.
Yeah, true.
They're going to happen, so we need to be prepared, not terrified.
It's about shifting that perspective from seeing corrections as like these catastrophes
Yeah,
to seeing them as opportunities.
opportunities.
Right. When the market dips, it's a chance to buy great companies at a discount.
He even talks about using what he calls a barometric reading, called the S&P oscillator, to help him anticipate those market shifts.
So when it signals that the market is overbought, he starts taking some chips off the table.
He's not trying to time the market perfectly.
Right.
But he's using those tools, he's using indicators to help him manage that risk.
The key for you is to develop your own approach to managing risk,
Yeah,
especially during those volatile times.
when things get choppy.
Right. Whether it's, a specific metric that you track,
Yeah,
maybe a gut feeling,
a gut feeling.
or a set of rules.
Yeah.
Having that plan will help you navigate those inevitable downturns with more confidence.
So it's not about avoiding them, it's about being prepared.
Be prepared. Exactly.
All right, so we're prepared for corrections, but what about that often overlooked asset class? Bonds.
Oh, yeah, bonds.
Cramer's Rule number 15 reminds us, don't forget about bonds.
It's easy to forget about bonds.
Now, I know bonds might not sound as exciting as, those high-flying tech stocks.
Right, right.
But they play a crucial role in a well-rounded portfolio.
They really do. I mean, bonds, they're often seen as the boring side of investing, but they offer valuable insights into the broader economy.
Yeah.
And those all-important interest rates.
He uses this fantastic analogy of watching a basketball game.
Okay, I like this.
He says, focusing only on the ball, the stocks, while ignoring the defense, the bonds, is a mistake.
Oh, yeah.
You're missing half the game.
That's a great analogy. So even if you don't, invest directly in bonds,
Yeah.
understanding how their movements can impact the stock market, that can give you an edge.
A real edge.
It's about seeing that whole picture, not just one piece of the puzzle.
I like that. Okay, so we're diversifying with bonds, managing risk, keeping our emotions in check.
Right, check, check, check.
Well, let's talk about a trap that I think a lot of investors fall into.
Okay.
Holding on to losers for too long.
Oh, I've been there.
Cramer's Rule number 16, never subsidize losers with winners.
All right, that's a good one.
It's a tough love message.
It is.
But it's about recognizing that sometimes the best thing you can do for your portfolio is to cut your losses.
Cut them loose.
And move on.
And, it's so easy to get emotionally attached to your investments, especially those that you buy into with such high hopes.
Oh, yeah.
You keep telling yourself, it'll bounce back, just give it time. But
Sometimes it doesn't.
sometimes it's just wishful thinking.
It is wishful thinking. Cramer has some blunt advice for dealing with this.
Okay, hit me with it.
He says, sell the losers and wait a day.
Okay.
You'll probably realize you don't want them back.
You probably won't. It's like staying in a relationship that's clearly not working.
Okay.
You keep hoping things will improve, but deep down,
It's time.
it's time to move on.
It's time. Cutting your losses, it stings in the short term,
Oh, yeah.
but it frees up those resources to invest in opportunities with greater potential.
Absolutely.
Okay, so we're cutting our losses, but what about hope?
Oh, hope.
Hope. You know that emotion that can really cloud our judgment?
Oh, yeah.
Cramer's Rule number 17, check hope at the door.
I love that.
He's not saying we shouldn't be optimistic about our investments, but he's saying hope alone.
Yeah.
That's not an investment strategy.
No, no, no.
It's about making decisions based on, reason, analysis, and a clear understanding of those risks and rewards involved.
Right.
Hope might feel good, but it won't pay your bills.
It won't.
And he gets particularly frustrated with hope in penny stocks,
Oh, yeah.
which he sees as a sign of denial, not sound investing.
Penny stocks are often driven by speculation and hype.
Oh, hype, yeah,
Little in the way of solid fundamentals.
right.
Investing in them based on the hope of, this quick windfall, that's just
That's a recipe for disappointment.
big time.
So we're checking hope at the door,
Check.
making rational decisions, we're diversifying.
Okay, check, check.
But what about the ever-changing nature of the business world?
Yeah, it's constantly in flux.
Cramer's Rule 18, be flexible.
I like that.
He's saying that our investment approach should adapt to the dynamic nature of the market.
It has to.
The business world is constantly evolving,
Yeah.
and the companies that we're invested in are no exception.
Right. New technologies emerge, consumer preferences shift, competitors rise and fall.
All the time.
All the time. And clinging to that rigid investment strategy in the face of those changes, that's what leads to missed opportunities.
Missed opportunities and even losses.
And losses.
He even challenges buy and hold.
Oh, wow. Which for decades has been like a cornerstone.
It's the cornerstone. He argues, while buy and hold could be a sound strategy for some investors,
Right.
it's not a one-size-fits-all.
It's not a one-size-fits-all. So the key takeaway, don't fall in love with your stocks.
Don't.
No, stay objective, be open to new information,
Yeah.
and be willing to adjust your strategy as the situation changes.
So it's about being nimble.
Nimble, adaptable.
That's
adaptable, right, not stuck in your ways.
Not stuck. Okay, so we're being flexible, but what about those cryptic clues that sometimes come out of the executive suite?
Oh yeah, what's going on behind those closed doors?
Cramer's Rule 19, this is a fascinating one. When the chiefs retreat, so should you.
Ooh, okay.
He's talking about executive departures,
Okay.
especially when they're unexpected or unexplained.
Yeah, that always raises a red flag.
It does. It really does. Executive departures, they could be a signal that, there's trouble brewing beneath the surface.
Yeah, think about it. Why would a CEO or CFO suddenly leave a company that's supposedly doing great?
Right.
There's got to be something more to the story.
And Cramer says he's rarely seen an executive depart for purely personal reasons.
Right.
There's usually more to it.
It's a good reminder to kind of look beyond those headlines, look beyond the press releases.
Yeah.
Sometimes what's not being said is just as important as what is being said.
Absolutely. Okay, so we're watching for red flags in the executive suite. But what about those companies that, seem to be unfairly punished by the market?
Yeah.
Cramer's Rule 20, giving up on value is a sin.
Okay.
He's talking about sticking with those undervalued companies that have those solid fundamentals,
Right.
even when the market's turning its lows up at them.
It's about having that courage to go against the crowd.
Yes.
Trust your own analysis.
Trust your gut.
Yeah, sometimes the market can be irrational.
Oh, it can.
And those great companies can get temporarily mispriced.
They do.
If you've done your research and you believe in that company's long-term prospects,
Long term.
don't let that short-term dip shake your conviction.
He tells a story about Apple when Tim Cook was CEO.
Oh, okay.
The stock had dropped significantly.
Really?
A lot of investors were bailing out, convinced that, Apple had lost its mojo.
Wow.
But Cramer, he saw the value and he held on, eventually reaping a pretty substantial profit.
There you go, patience. It's a great example of how patience and a long-term perspective that can really pay off.
It can.
The key is to understand the difference between a temporary dip and a permanently damaged company.
Big difference.
Sometimes it takes time for the market to recognize that true value.
It does.
And if you're willing to wait, you can be rewarded handsomely.
Okay, so we're being patient, seeking value, being mindful of those executive departures. But what about all the noise and the hype that constantly bombards us from the financial media?
Oh, it's a lot to sift through.
Cramer's Rule 21 is a timely reminder. Be a TV critic.
Okay.
He's urging us to be skeptical of everything we hear on those financial news channels,
Even from those seemingly credible sources.
even from those big names.
Wow.
The financial media, it's a business.
Right.
Their goal, attract viewers and generate revenue.
Makes sense.
This means they often focus on sensational stories, dramatic predictions, those hot stocks that are likely to, grab attention.
Right.
But this type of coverage, it can really distort reality
It can.
and lead investors to make, emotional decisions.
Yeah.
Cramer acknowledges guests on these financial news shows often have their own agendas.
Yeah, they do. They do.
They might be promoting a stock they own or trying to influence the market in some way.
Yeah.
Their insights might be valuable, but take them with a grain of salt.
A grain of salt, always.
Always. And do your own research.
It's a call for critical thinking, right?
It is.
Don't just accept everything I hear at face value. Do your own research, form your own opinions, and don't be afraid to challenge conventional wisdom.
Challenge it. Okay, so we're being critical thinkers. We're not just blindly following the hype.
Okay.
But what about those dreaded profit warnings that can send a stock plummeting?
Oh, yeah, those are never fun.
Cramer's Rule 22 is a specific rule of thumb. He's developed this over years of experience.
Yeah, he's seen it all.
Wait 30 days after warnings.
Okay. Interesting.
So when a company issues a profit warning, it's essentially saying that their earnings are going to be lower than expected.
Yeah,
This can send shockwaves through the market
it does.
because that stock price to, drop sharply.
It can plummet.
But Cramer's rule suggests that initial reaction
Yeah.
might be an overreaction.
Really?
He says often there's more bad news to come after a warning.
Mm.
That initial drop might not fully reflect the company's challenges.
Okay.
He says it's like an earthquake.
Okay.
The first tremor might be the biggest, but there are often aftershocks.
Right, that can cause further damage.
Cramer's 30-day rule gives the market time to digest that negative information.
Okay.
And for any potential further news to emerge, it's about being patient and avoiding the temptation to buy the dip too quickly.
I see. Don't rush in. So we're being patient. We're waiting for the dust to settle after a profit warning.
We are.
But what about those stocks that seem to be universally loved by Wall Street?
Everyone's piling in.
Yeah, everyone's on board.
Cramer's Rule 23, beware the Wall Street hype.
Ooh, I like this one.
He's cautioning us about the dangers of getting set up in those market trends, especially when they're based on shaky foundations.
Yeah, sometimes the hype gets ahead of reality.
It does.
It really does.
When everyone on Wall Street is, singing the praises of a particular stock,
Yeah,
it's tempting to believe that they must be onto something, right?
right.
But as Cramer points out, sometimes the hype,
Yeah,
it can get ahead of reality.
it can.
He uses the example of Valiant Pharmaceuticals.
Okay.
Now, this was a company that soared in price due to acquisitions and analyst hype,
Hmm.
but ultimately collapsed when its, underlying weakness was exposed.
It was a classic case of the emperor having no clothes.
It was. It's a powerful reminder to look beyond the headlines,
Yeah,
analyze a company's true value before jumping on that bandwagon.
right. Don't let the excitement of the crowd cloud your judgment. Okay, so we're being skeptical of the hype, but what about our own investment ideas?
Right. How do we make sure that we're making those sound decisions and not just chasing rainbows?
Yeah, that's a good question.
Cramer's Rule 24. This is a great exercise in self-reflection. Explain your picks.
Ooh, I like this.
This rule is all about the power of articulation.
Okay.
So when you have to explain your investment thesis to someone else,
Yeah,
it forces you to clarify your thinking
right.
and expose any potential flaws in your logic.
So it's like presenting your case to a jury. You need to be clear, concise, and convincing.
I love that. Cramer used to make his hedge fund managers sell him on their stock picks
Oh, wow.
before he approved the purchase, and he found that this process helped to really sharpen their thinking,
Yeah.
expose any weaknesses in their arguments.
So the actionable advice for you, the listener, find someone to discuss your ideas with, even if it's not, a financial professional. Just talk through your reasoning.
Talk it out.
It can help you to identify those blind spots, make those more informed decisions. All right, so we're articulating our investment theses. We're being those critical thinkers, not letting emotions cloud our judgment.
We are.
And this brings us to Cramer's final rule, and I think it's perhaps his most important.
Okay, let's hear it.
There's always a bull market somewhere.
I love that.
It's a message of optimism
It is.
and a reminder that even in those darkest of market times, there are always opportunities out there.
There are.
The market, it's vast, it's complex, it's an ecosystem, really.
It is.
Countless sectors, industries, and companies. While some sectors might be struggling,
Right.
others are likely thriving.
Absolutely.
It's about being proactive, doing your research,
Yeah.
and staying open to those new possibilities. Cramer truly believes there's always a sector or group of stocks performing well.
Somewhere.
You just got to find it.
So after our deep dive into all this Cramer wisdom, what is some of your biggest takeaways?
Well, for me, it's the emphasis on psychology. It's so easy to get swept up in the excitement, the fear the market throws at us.
Oh, yes.
Cramer reminds us the best investors are the ones who can really keep those emotions in check.
I completely agree. And his rule, check hope at the door, that's a perfect example.
Oh, yeah.
Hope, powerful motivator, but it's not a substitute for sound investment principles.
Not at all. Another takeaway for me is that flexibility. You got to be adaptable. The market's always changing. We need to change with it, right?
Absolutely. And his willingness to, challenge those old dogmas like buy and hold, that's inspiring. He's not afraid to go against the grain if he thinks it's best for his investors.
And speaking of going against the grain, that cash is for winners rule,
Oh, yeah.
that's a powerful reminder. Sometimes the best move is to do nothing.
Do nothing.
Be patient, wait for the right opportunity.
Instead of feeling like you always have to be in the market,
Yeah, that FOMO.
the phono, it's about discipline.
Discipline, being selective. Cramer's rules, they're all about giving us those tools, that mindset
The tools.
to make those smart investment decisions.
This has been such an insightful deep dive. I feel like we've really only just scratched the surface of all this Cramer wisdom.
We have, but even just these highlights from his 25 rules, I think it's a great starting point.
It is a great starting point.
These rules aren't just for Wall Street insiders.
No, they're not.
They're for anyone who wants to take control of their financial future.
Absolutely. And whether you're just starting out or you've been investing for years, there's something here for everyone.
It's really about developing that sound investment philosophy.
The philosophy.
That'll serve you well over the long haul.
So to wrap things up, I encourage everyone to dig deeper into Cramer's 25 rules and, see what resonates with you. And remember, there's always a bull market somewhere. So stay curious, stay informed, and never stop learning.
It's interesting how many of these rules, they connect back to everyday life.
Oh, absolutely.
Even if you're not like a stock market guru.
Right. Right.
It's about understanding human nature,
It
really.
is. It is.
Our own behavior and that of the market as a whole.
Absolutely. They're like, Cramer's rule, when the chiefs retreat, so should you. It's basically saying pay attention to the people at the top.
Yeah.
If they're bailing out, there's probably a reason.
It's like that classic scene in a movie.
Okay, yeah.
You see the rats fleeing a sinking ship.
Oh, yeah, yeah.
You just know something bad is about to happen.
Right, right. And it applies to so many things beyond investing.
It does.
Whether it's a job, a relationship, or even just a social group.
Yeah.
If the leaders are losing faith, it might be time to reevaluate your own involvement.
Definitely. And then you have Cramer's rule, giving up on value is a sin. It reminds us to sometimes, have that courage to go against the grain.
To be a contrarian.
To be a contrarian. Trust your own judgment, even when everybody else is saying you're wrong.
Think about all the great innovators throughout history.
Oh, yeah.
They were ridiculed.
Oh, yeah. They were dismissed for those unconventional ideas.
Like Galileo.
Galileo, yeah.
Condemned for saying that the Earth revolved around the sun.
But he was right, and eventually the world, it catches up.
It does.
So sometimes, being a contrarian can be a good thing, especially when it comes to investing.
But it doesn't mean we should just blindly buy any stock that's, fallen out of favor.
No, no, no.
We still got to do our homework.
Absolutely. Understand the company.
Understand it, yeah.
Their fundamentals.
Their fundamentals, make sure we're not catching a falling knife, right?
Right, exactly. It's about finding those hidden gems that the market has mispriced.
The hidden gems.
The companies with that solid potential that are just waiting to be discovered.
I love that. And this is where Cramer's rule about do your stock homework comes in. He's always saying knowledge is power.
Knowledge is power. It's not enough to just rely on those hot tips or rumors.
No, those inside scoops. No.
No, you got to dig deep, understand the companies you're putting your money into.
Yeah.
Make those informed decisions based on facts, not speculation.
And thankfully, we live in an age where information is more accessible than ever.
Oh, it is. We've got company websites, financial news, analyst reports, even social media.
Social media.
It can be a helpful tool to stay informed.
But you got to be discerning about those sources, right?
You do.
Always double-check the information. Cramer's be a TV critic rule, that's a great reminder.
Oh, it is.
He's not saying ignore the financial news completely.
No, no, no.
But be a critical thinker.
Absolutely. Don't just passively absorb whatever's being thrown at you.
Don't drink the Kool-Aid. So sometimes the best thing we could do for our portfolio is step away from it all.
Yeah, sometimes you just got to walk away.
Cramer's cash is for winners rule.
Oh, yeah.
Might seem counterintuitive, right?
It does.
But it's recognizing that sometimes the best investment is no investment.
That's right, especially when things are uncertain, when the market's volatile.
Follow.
Yeah, holding cash, it gives you that flexibility, that option to pounce on opportunities.
When they arise.
Without having to sell other investments at a loss.
Exactly. It's like having an emergency fund for your portfolio.
It is. It's like a safety net, a cushion, that peace of mind.
And it's about, recognizing that we don't have to be in the market all the time to be successful.
That's a good point, a good point. It's about being patient, waiting for that right pitch.
Speaking of patience, Cramer's rule, never subsidize losers with winners. This is a tough one.
It is. It is a tough one.
But it's crucial.
It is. It's recognizing when an investment has run its course.
Yeah.
Cutting your losses instead of just clinging on to hope.
It's like, pruning a tree. You got to cut away those dead branches to let the healthy ones flourish.
That's a great analogy. Sometimes it means accepting a loss.
It does.
And moving on.
Moving on.
It's not easy, but it's often the best thing you can do for your portfolio.
So it frees up those resources.
Yeah.
To invest in new opportunities with bigger potential.
Exactly. So as we wrap up our deep dive into Jim Cramer's 25 rules, what's the final thought for our listeners?
And what's that nugget of wisdom they can walk away with?
Investing doesn't have to be this big, scary, complicated thing.
Right.
By following some simple rules and really being in tune with our own psychology,
Oh, yeah.
we can take control of our financial future. Cramer's rules are a great roadmap, not just for the market, but for life, too.
I love that. They are a roadmap.
Stay curious, stay informed, and never stop learning.
That's great advice. This has been an incredible deep dive into Jim Cramer's world.
It really has. So much to learn from his 25 rules.
A lot of wisdom packed in there. So thanks for joining us on this journey.
It's been a pleasure. And remember, folks, there's always a bull market somewhere. Go find it. 36.